So the next topic is scope of total income. What exactly is this? What is the amount to be taxed? The income is arrived or earned by an individual from different forms, from different source, and what is the tax that can be taxed, or what is the amount that can be taxed is nothing but the scope of total income. The first one is mentioned in section 5 of subsection 1. The second one is section 5 of subsection 2. The section 5 of subsection 1 is regarding the residents and resident companies only resident companies. And section 5 of subsection 2 is regarding the non-resident companies. There is no rule that in the Income Tax Act, if the company is non-resident of India, there is no tax liability for them. No, it is not like that. Even the non-resident companies has to pay the tax to the Indian government. That we will see further. And anyway, we know that the resident companies must pay the tax in India. Let us see the scenarios how it is taxable in India. First one is any income received in India or deemed to be received in India is taxed in India. First one, look at the first one. Received in India. The income, anyway, it is received in India, then it is taxed. The work is done in India and taxed in India. The second one is deemed to be received in India. Suppose you have done the work in India, you went to some foreign country and you met an individual there, and there he paid you the money which is supposed to be paid in India. You are supposed to receive the money in India, but you have received in some other country, then still it is taxable in India. Clear? And the next one is the accrues in India or arises in India, then it is taxable in India. It is an Indian company. The income has accrued in India and it has arisen in India, then it is taxable in India. You have to pay the tax earned, the income earned to the Indian government. And the next one is accrues or arises in India. Income has accrued in India and arises in India. I think accrues or arises outside the India. Already we know, anyway, the income accrued in India or arises in India is taxable in India, which is the second scenario we have seen here. The only thing is here accrues and arises outside the India. You have the income which is accrued in some other country. Suppose if you are a technician, you know how to repair the machineries, the huge machineries. Then you went to the US, you have done that. If you are Indian company, you went to the foreign country and you the income has accrued there. You worked there and the income has generated there, and you have received the money there itself. then you come back to the India and pay the tax to the Indian government just because you are the residential companies. But see the second scenario: accrues in India, arises in India. You have generated the revenue in India and you have received the income in India. Then it is taxable in India. But here it is different. You have Indian company, you went to the foreign, there the income is accrued, there you have received an income. Then it is taxable in India. And these are the scenarios for the resident companies. Now come back to the non-resident companies. For the non-resident companies, you have only two scenarios. One is received in India and deemed to be received in India. And the next one is accrued or arisen to him outside India. So, any income which is received in India for the non-resident company, pay the tax in India and leave to your country. See, ultimately the government want the revenue. So that is the reason, even if it is a foreign company, if it is received in India, pay the tax to the Indian government and deem it to be received in India. Regarding this, I have given an example of 2G spectrum of Vodafone in your class. Remember that and understand it in better. And how they have floated a company and how they have done the 2G spectrum scam. This is regarding the deemed to be received in India. We have discussed about how the Supreme Court gave the judgments and what are the arguments between the judgments. Also we have discussed in the class regarding the 2G spectrum of Vodafone, which is the income non-resident company which is received in India is taxable in India and deemed to be received in India, which is taxable of the the tax liability of the deemed to be received in India is supposed to pay to the tax is supposed to pay to the Indian government. So the last one is the accrues or arises him outside the India. For example, non-resident company accrues or arises him outside the India but derived from the business controlled or a profession set up in India. Understand properly. Non-resident but accrues and arises him outside the India. Still it is taxable in India. How? See, that derived from the business controlled in India. The business is controlling in India. Whatever the business is controlled in India, but the business is operated outside the India. From that particular company, they are generating the revenue and they are receiving the revenue of a non-resident company. Still it is taxable in India because the person whoever is paying it to the non-resident, that particular company is controlled by the Indian resident. We have seen the topic in the residential status regarding this incorporation. The residential status of the company is on incorporation and control and management. The control and management of a non-resident company is in India, the control and management of its affairs. Then in that case, that particular person, the CEO or a CFO, is supposed to deduct the TDS and remit it to the government. That is how they will be operating the tax administer. If they are not deducting the tax, if they are not deducting the TDS, the government will pay the huge penalties on this. So that is the reason they need to deduct the TDS for the non-resident companies, which is accrued or arise to him outside the India also, but that particular company's control and management is within India.